$10,000. That is all you needed to invest in 1969. If you put it in the average professionally managed fund, the kind with the sharp analysts, the research teams, the Bloomberg terminals, by 2018, you would have $817,000. Not bad. But if you had done something much simpler, something almost embarrassingly boring, you would have over $1,090,000. The difference? $275,000. Gone. Not from bad luck, not from a crash, from fees and the arrogance of thinking you could beat the market. That is the central argument of A Random Walk Down Wall Street by Burton Malkiel, Princeton economist, former member of the President's Council of Economic Advisors, and one of the most quietly influential finance thinkers of the last 50 years. He first published this book in 1973. It now has 12 editions. And the core message has never changed. The stock market cannot be consistently beaten. Not by professionals, not by algorithms, not by you. And the sooner you accept that, the richer you will be. Let's walk through exactly why and what to do about it. A random walk is a mathematical concept. It means future steps cannot be predicted from past history. Applied to the stock market, it means this. Knowing that a stock went up yesterday tells you nothing about what it will do today. Past prices are useless for predicting future prices. This sounds simple, but it demolishes the entire foundation of one of Wall Street's most popular professions, the technical analyst. Malkiel's bold claim is that a blindfolded chimpanzee throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. That is not a metaphor. Researchers have actually run this experiment. The dart-throwing chimp wins more often than you would think. But before we get to the evidence, we need to understand the two competing theories of how stocks are supposed to be valued, because Malkiel believes both are flawed. For a century, investors have argued about what a stock is actually worth. Two schools of thought dominate. The firm foundation theory. Every stock has an intrinsic value, a true worth based on the company's future earnings, dividends, and growth. Find that number, compare it to the market price, and trade accordingly. If the stock is trading below its true value, buy it. Above it, sell it. This is the gospel of fundamental analysis. Warren Buffett lives here. The castle in the air theory, aka technical analysis. The other school says intrinsic value is largely irrelevant. What matters is predicting what other investors will believe a stock is worth. Keynes called it the newspaper beauty contest. You are not voting for the most attractive face. You are voting for the face you think other people will vote for. 2 steps removed from reality. In the stock market, it does not matter what a company is actually worth. It matters what the crowd will pay for it next week. Malkiel's view. Both theories are partially right, and both are regularly weaponized by the market to create devastating bubbles. Because when castle in the air thinking takes over, when everyone is buying because they believe someone else will pay more, you get one of the most reliable patterns in all of financial history. Financial bubbles repeat in every generation. The Dutch tulip bulb craze, 1637. A single tulip bulb trading for 10 times the annual wage of a skilled craftsman. People mortgaged their homes to speculate on flowers. Then the price collapsed in weeks. Overnight ruin. The South Sea Bubble, 1720. A British company with a trade monopoly that barely existed. Its stock rose 900% in a year. Sir Isaac Newton invested, lost a fortune, and said he could calculate the motions of heavenly bodies, but not the madness of people. The Nifty 50, the 1960s. 50 blue-chip American companies, Polaroid, Xerox, Coca-Cola, declared one-decision stocks you could hold forever. Price-to-earnings ratios of 80, 90, 100. Then the market crashed and most fell 80%. The dot-com bubble, 1999 to 2001. Internet companies with no revenue, no profits, sometimes no product, valued at billions. When it popped, over $8 trillion of market value evaporated. $8 trillion. The entire annual economic output of Germany, France, the UK, Italy, Spain, the Netherlands, and Russia. Gone. The US housing bubble. 2007 to 2009. The entire global financial system nearly collapsed. Every single bubble followed an identical pattern. A new opportunity creates genuine excitement. Prices rise. The rise attracts more buyers. Buyers justify inflated prices with new frameworks. The last greater fool runs out. The castle collapses. Malkiel's point is brutal. Professional institutions participated in every one of these bubbles. The experts were not standing aside watching. They were building the castles. To be aware of the bubbles, or to profit from the castles that are being built, people mainly resort to two analysis approaches. One of the two is technical analysis. But does it work? The book title tells you the answer. If past prices cannot predict future prices, if the walk is truly random, then the entire field of technical analysis is based on a fiction. Technical analysts study price charts looking for patterns, head and shoulders, double tops, support and resistance levels, momentum indicators. The idea is that price history contains signals about where a stock is going. Malkiel says this is horoscope reading with a Bloomberg terminal. The evidence is relentless. Researchers took price charts and deliberately randomized them, feeding them to professional chartists without labels. The chartists identified the same patterns in the fake data as in real data. The patterns existed in their minds, not in the market. When you simulate a stock price by flipping a coin, heads means up, tails means down. The resulting chart is indistinguishable from a real stock chart to the human eye. You will see uptrends. You will see breakouts. None of it means anything. Malkiel's most scathing observation. Chartists are often seen with holes in their shoes and frayed shirt collars. If the method worked, the people teaching it would be rich. They are not. How about fundamental analysis? It has almost no edge as well. Studying earnings, cash flow, competitive position, and management quality is better, but still not enough. Here is the problem. Every publicly available piece of information about a company is already reflected in its stock price, almost instantly. Because thousands of brilliant analysts are already reading the same data you are. This is the efficient market hypothesis. It has three forms. Weak form. All past price information is already in the price. Technical analysis is useless. Semi-strong form. All publicly available information is already in the price. Fundamental analysis of public data gives no consistent edge. Strong form. Even private information is quickly arbitraged away. Almost no one can consistently beat the market. Malkiel endorses the semi-strong form. The implication, by the time you have read the analyst report, the information is already priced in. Studies confirm this repeatedly. Roughly 80% of actively managed funds underperform their benchmark index over any 10-year period. Adjust for fees and the number gets worse, and the funds that did outperform in one decade have no better than random odds in the next. The past performance disclaimer on every investment product is not legal boilerplate. It is empirically true. Other than the analysis methods we use, the irrational investors inside all of us also contribute to our failures in investing. Behavioral finance catalogs the systematic ways investors behave irrationally. Overconfidence. Most investors rate themselves as above-average stock pickers. Mathematically impossible. Overconfidence leads to excessive trading, and every trade costs money. The more you trade, the more you lose. Loss aversion. Losing $1,000 hurts roughly twice as much psychologically as gaining $1,000 feels good. This asymmetry causes investors to hold losing positions too long and sell winning positions too early. Exactly the wrong behavior. Herding. Humans feel safer doing what everyone else is doing. In markets, this creates momentum. Prices rise because they have been rising, not because underlying value increased. This is precisely how bubbles form. Rational investors keep buying near the top. Anchoring. Investors fixate on arbitrary reference points. A stock that was $100 and fell to $40 feels cheap, even if $40 is still twice what it is worth. The $100 price is an anchor that distorts judgment. Malkiel's conclusion: the market is not perfectly efficient, and behavioral biases do create temporary mispricings. But exploiting them consistently, before the rest of the market corrects them, is extraordinarily difficult. The attempt costs more than it returns. But don't worry, the practical solution to investing is index fund. If you cannot beat the market, join it. Own the whole market. That is what an index fund does. A broad market index fund holds every stock in the index in proportion to its size. When the market goes up, you go up. When it goes down, you go down. No stock picking, no manager fees, no trading costs. Malkiel's 3-step practical framework. Step 1, the no-brainer step. Put the core of your portfolio into low-cost, broad-based index funds or ETFs, domestic and international. The major providers offer index funds with expense ratios under 0.1%. That is $10 per year on every $10,000 invested. Compare that to the typical actively managed fund charging 1 to 1.5%. On a $1 million portfolio, that is $10,000 to $15,000 a year, every year, regardless of performance. Over 30 years, the compounding effect of that fee difference is staggering. Step 2, asset allocation by life stage. In your 20s and 30s, own mostly stocks. You have time to ride out crashes. As you approach retirement, gradually shift toward bonds and more stable assets. A rough rule: subtract your age from 110. The result is the percentage of your portfolio that should be in stocks. At 30, roughly 80% stocks. At 60, roughly 50% stocks. The single most important investment decision you will ever make is not which stock to buy. It is your asset allocation, the ratio of stocks to bonds at each stage of life. Step 3, keep costs near zero. Every fee you pay is a guaranteed loss. Expense ratios, trading commissions, advisor fees, load charges, all compound against you over decades. The investor's enemy is not the market, it is friction. Malkiel also recommends regular rebalancing. Once a year, reset your allocation back to target. Sell what has grown above its target weight, buy what has fallen below. This forces you to systematically buy low and sell high, without requiring any judgment about individual stocks. And there are 4 rules you need to remember. On diversification, don't just diversify across stocks. Diversify across asset classes and geography. U.S. stocks, international stocks, emerging markets, bonds, real estate investment trusts. Different assets fall at different times. Owning all of them reduces the catastrophic scenario. On market timing, don't try. Nobody can consistently predict market tops and bottoms. The cost of being out of the market on its 10 best days in a decade is devastating to long-term returns. Those days almost always come during periods of maximum fear. The investors sitting in cash after a crash miss them entirely. On dollar cost averaging, invest a fixed amount at regular intervals, regardless of market conditions. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more. Over time, this mechanically lowers your average cost per share without requiring you to predict anything. On tax efficiency, take full advantage of tax-advantaged accounts, 401k, IRA, Roth IRA, before investing in taxable accounts. The tax savings compound just as powerfully as investment returns. Every dollar you don't pay in tax is a dollar that keeps compounding. Go back to 1969. $10,000. 2 paths. 1 path. Hire the experts, pay the fees, trust the analysts who employ fundamental or technical analysis, chase the returns. The other path? Buy an index fund, ignore the noise, let time do the work. By 2018, the gap between those 2 paths was $275,000. Burton Malkiel spent 50 years making the case for the second path, not because investing is easy, but because most of what makes it hard is invented. The complexity, the jargon, the mystique of Wall Street, it all serves one purpose: to justify fees. Strip it away, and what is left is simple. Own everything, pay almost nothing, stay the course. That is the random walk. If this breakdown gives you something, subscribe. See you next time.